Hello everyone, welcome back to One Finance. In this video, we're going to cover financial ratio analysis part 3. And just a very short recap, financial ratio analysis is all about examining the financial health of a company. And it's actually known as fundamental analysis. It's supposed to tell you what companies to buy, unlike technical analysis, which is more focused on when to buy those companies. So in particular, we're going to cover debt management ratios. So we have three. We have debt to asset ratio, we have debt to equity, and times interest earned. So first we have the debt to asset ratio. It measures the portion of assets financed by debts. And our formula is total debt divided by total assets. So in this case, we have 300 divided by 1,500. And that would give us a 0.2 debt to asset ratio. So that would mean that for every 1 peso of asset, that is actually allotted, let's say, 0.20 centavos. Okay, so that's how we interpret this. Next, we have the debt to equity ratio. It measures the portion of equity financed by debt. So our formula is, again, our numerator is debt divided by the stockholders' equity. And in this case, that's 300 divided by 1,200. That will give us debt equity ratio of 0.25. And our interpretation is that for every 1 peso equity of the company, 0.25 centavos is allotted to that. Okay. And lastly, we have the times interest earned. So it measures how well the company can pay interest relative to debts. So here, our formula is earnings before interest and taxes divided by interest expense. And that would give us 550 divided by 20. And the times interest earned is actually 27.50. So this is the number of times that the interest expense is actually covered by the earnings of the company. That's 27.5 times. Or we can also say that for every 1 peso interest expense of the company, they have 27.50 pesos earnings coverage. So here we have a better way of evaluating the debt management ratios. Now, since the two are actually debt ratios, we would want to see these figures as low as possible compared to the competition in the industry. And then while times interest earned, since this is the capacity of the company to settle its short-term interest expenses, we would want to see this figure higher as possible. So with these figures versus the competition in the industry, that will give us a signal for buy because their figures are better. But if you're going to look at it the other way around, okay, so the debt ratios here are, if you're going to look at, these are actually higher than um, the competition in the industry. So the company here is highly leveraged, we can say. But again, if you're going to look at the exposure of the competition in the industry, is far below their debt ratios. So that would give us a signal of, not to buy or try to look for other companies with better positions. And for the times interest earned, the 27.5 is actually good, but if you're going to look at the competition and the industry, they have higher coverage ratio. So again, this would give us, a potential not to buy signal for one finance company. Okay, so that will be all in this video. I hope that you learned something about debt management ratios. Once again, thank you very much for dropping by and see you in part 4.